Hello, everyone. So, personally, I only trade options. I do not trade stocks much anymore, at least directly. And I think options are the best thing going as far as trading is concerned. But they can be extremely dangerous and extremely risky. And the reason why is you're human. You have a temptation. You're tempted to take too much leverage, and that will easily wipe out your account. So in this video, I'm going to show you an example scenario comparing three different strategies. One is buying 100 shares, one is buying one call option, one is buying 50 call options, and showing you with a few different scenarios what you gain and what you lose and how easy it is when you buy those 50 call options to wipe out your account. So let's do this example scenario. Let's assume you have $100,000 to invest and you're interested in trading some stock called stock, and it's trading at $1,000 per share, right? And so you can buy 100 shares. 100 times 1,000 is 100,000. You can also buy a call option with a strike price of $1,000, expiring next Friday for say $20 a share. And just to remind people, equity options are for 100 shares of the underlying stock. So the cost of the call option would be 20 times 100 is $2,000, and it will be the right to buy 100 shares at $1,000 at the expiry or before the expiry, which is in our case hypothetically next Friday, but you can assume any date if you want. Okay, so let's compare the three strategies. So you can do a strategy like you can buy 100 shares and you can pay $100,000, right? You can buy one call option and pay $2,000 just the premium, or you could say, ooh, it's so cheap, only $2,000, I can buy 50 of these, cost you $100,000. So now let's look at the theory. In theory, the max profit for buying 100 shares is unlimited, right? Because the stock can go to infinity. But in practice, it's not really unlimited. But just keep that in mind. Buying one share, one option is unlimited, and buying 50 call options, I should write this is 50 times unlimited, right? But in practice, obviously, stocks don't go to infinity, so. But you have a lot of upside for these three. You have the similar upside for the first two, and the last one you have 50 times the upside. So I should have written 50. But this is where the key thing is. If you buy 100 shares, in theory the max loss is $100,000. In practice, it's way less than that, unless you do like some penny stock, like I used to do, like Mullen and Wish and things like that. You're not going to lose 100% of your investment, especially in a few days, even with terrible earnings. So let's say max loss in practice will be like 20,000. If you buy one call option, the max loss is 2,000. You just lose your premium. And if you buy 50 call options and all of them expire worthless, you lose all your money. And this does happen. This does not happen really in practice. This does happen. So it's extremely risky. So let's go through a detailed scenario that I tried to explain to my uncle, who's new to options. So let's assume we have three scenarios. The stock can crash to $500, stock stays at $1,000, or the stock can go up to $2,000, right? So if the stock crashes to $500 and we bought 100 shares, we're down 50,000. Why? Because we lost 500 a share times 100 shares, it's 50,000. If we bought the call option, it expires worthless, so we just lose our premium of $2,000. But if we buy 50 call options, now it's 50 times 2,000, we lose all $100,000. So we have wiped out our account in this case. Let's say stock stays at $1,000, which is very possible, obviously. So if you buy 100 shares, you break even. If you buy one call option, you lose $2,000, you just lose the premium. It's all the same as the above case, pretty much. And if you buy 50, since all of them expire worthless, you lose 100,000. So this illustrates one thing. It illustrates that the break even is lower if you just bought the stock than you bought the option. The break even for buying the option in our case is $20 more because the option costs $20 per share. So the break even is less for buying the stock. You can play tricks and games, like you can do things called the bull call debit spread, and we'll talk about it in another video, where you can lower your break even for the call type thing. But the bottom line is this, is the break even is higher, but again, if you buy 50 call options, you lose all your money, your account is wiped out. So why would people even think of this 50 option thing? Well, let's look at the other case. What if the stock moons to 2,000? Like, let's say this is an Nvidia or something. So if you buy 100 shares, you're up $100,000. Why? Because 1,000 times 100 shares is 100,000. If you buy one call option, then you're up 98,000 because remember your 100 shares you're allowed to buy are worth 100,000 more, and you pay 2,000 for the option, so you net 98,000. But what if you buy 50 call options? Now what you have is you have 50 contracts, and each is worth 100,000 as explained here. So contracts are worth now 5 million, but you paid 100,000 up front for those contracts. 2,000 in premium times 50 contracts is 100,000. So you subtract 5 million. You do 5 million minus 100,000. You get 4.9 million. So basically, buying 50 contracts, you hit the jackpot here. So that is why people are tempted to do calls, because you have so much leverage and you can make so much money. So the moral of the story is, like every temptation in life, temptations are bad. Usually bad, and you should usually try to avoid them because you can lose everything. Maybe the most reasonable thing is between the two, between buying one call and 50 call. Might be a little bit more reasonable. Of course, everything I say is not financial advice. So the moral of the story is you can easily wipe out your account if you over leverage with call options. Call options have higher break even than the actual stock, and but at the same time, if you're just buying one call option per 100 shares, in theory, it's less risky than buying 100 shares because it's like having insurance. Like if the stock crashes, I only lose $2,000. So having one call option is kind of like it's honestly, because of put call parity, it's pretty much more or less minus some constants, the same as having the stock and buying a put option for protection. Anyways, so I hope you guys enjoyed this video. Please like and subscribe. If you're new, I'll make a lot of these videos. And by the way, if you guys are interested in actual Python stuff, this is all dash code. All this stuff is dash code. So I will put it, and you can view it at www.trademamba.com. Yeah, thank you.